Yeah, pretty much. You have fiscal monetary policy going the other direction. It's kind of like slamming on the gas pedal while like holding the emergency brake, right? It's just, you get a very weird effect. Then it becomes which one's bigger. And overall, fiscal is bigger, and that's what we're going through right now. At least for the market in aggregate, there are some sectors that are more affected by monetary policy, but overall, fiscal policy is winning. And then, ironically, and the key part is that tight monetary policy feeds into more fiscal by increasing the government interest expense, which increases the overall deficits. And there are people and companies on the other side of those deficits, on the receiving side. So, for example, if I have a fixed rate mortgage on my house and I have a bunch of cash equivalents in money markets and T bills and things like that, then the higher the Federal Reserve raises interest rates, my liabilities don't change. Like my monthly interest expense doesn't change, but the income I get from my cash equivalents goes up, and so that I can actually spend more into the economy. And you can imagine there's a lot of upper class, upper middle class, especially older investors, baby boomers, older generations that have quite a bit of cash equivalents and, either no debt or fixed rate debt. And so they're in a very different situation than you'd expect from normal tightening policies. You also see this in corporations. So, for example, there are many large profitable companies that have very long-term corporate bonds at low interest rate. That's their liability, and then they have plenty of cash equivalents that their interest rates go up when interest rates go up, and so they're receiving a lot of interest income, and they're able to spend that on acquisitions or dividends or buybacks and things like that, and reward shareholders. And so all of that does trickle into the economy, just maybe not as rapidly as something like stimulus checks, just because of where that income's going, but it is a stimulatory force.
So who's affected? Is it the banks that are really the ones that are having to, I guess, take or I guess offset all this stimulus, as you said, the high interest rates?
So it depends on the bank. Even the banks have divergence. If you're a very large bank, most large banks don't have a ton of commercial real estate exposure. They're facing some pressure from the fact that, in general, they have mortgage loans and things like that on their asset side. So they can be somewhat squeezed, but then it really comes down to the individual bank, right? So larger banks tend to be in more secure condition than like kind of regional banks, and then it comes down to individual banks manage duration better than other ones. So banks that are heavily in commercial real estate, a lot of them are in trouble. Whereas, for example, American Express, they're a bank entity, and they've been doing great, because they don't really have that duration mismatch problem. So yeah, it really depends on the type of financial institution.